Hello and welcome to the latest edition of Citrus Bites from our offices in Sevenoaks. So I think it was around about May this year that I last spoke to you about what was going on with Iran and the war between America and Iran, talked about oil prices and talked about UK gilt. So it feels about time we saw what had changed since May. And there is a little bit of me that says, well, not an awful lot potentially. So I thought we'd start by looking at the price of a barrel of oil. So I always say on this one, I tend to use Brent crude when looking at the price of a barrel of oil. It's a really good indicator. It's the most common indicator used. There are some other kind of measures around things like something called West Texan, but we'll use Brent crude. So last time we spoke, oil was getting volatile. The war had broken out. Strait of Hormuz, where we talk about 20% of the world's oil passing through that strait, was basically closed. Well, as of today, in spite of some false dawns, it remains closed. As you can see from the graph, what that meant was oil prices started to spike. So I think we're going back to kind of May time, spiking at around towards $120 a barrel, then easing right back because we thought at one stage peace agreement was in place, everything was open again. That's that meant oil started to come back down, but now we have the reality that's not the case. So oil is elevated again to about $90 a barrel. So it may be a case kind of think, well, this has been going on now since, about 6 months. So really, were we just riding through the impact? Is everything really all right? Maybe not as bad as we thought. Going back, seems where are we 4 months ago now? Actually, a lot of the noise was about what's going to happen to our summer holidays. Can we still go away? Lots of people's journeys would be cancelled. There'll be no jet fuel. Actually, the airlines seem to have coped with that rather well, making sure that routes were, let's just say, streamlined. There wasn't any wastage. There's been a little bit absorbed through extra prices. There's been some oil hedging. So for a lot of people that were concerned that their summer holidays won't go ahead, well, actually, they did go ahead. So well done to the airlines for keeping flying and keeping everything in play. Um, However, we then go, well, should we care? If things like that seemingly are all okay, apart from the terrible human impact, is there anything else we're worried about? And the answer would typically be, well, an elevated oil price would expect to start coming through to inflation pressures. So let's just remind ourselves why this might be the case. So oil price goes up. It costs more money to get the items, for example, in the supermarket a lot of the time from A to B. But it's not just the transporting of them. It's the cost of getting the fertilizer to them for those that have fertilizer applied. It's the cost of maybe greenhouse heating for vegetables or fruit grown in a greenhouse. It's the cost of farmyard machinery, maybe, that's out there with the harvest. So a lot of the input costs, if you like, for food will start playing out through elevated transport costs. So we'd expect to see some pressure coming through to inflation. But here's some really good news. When we look at this, we go, well, actually, in the 12 months to June, CPI actually kind of month on month from the 12 months to May, we actually saw CPI cooling slightly from 2.8 to 2.6%. And actually, core CPI, which I talk about a lot for regular viewers of this production, will also note that stayed at 2.6 as well. So we're expecting to see higher inflationary pressure. But that higher inflationary pressure at the moment hasn't come through. In spite of all the kind of indicators going, well, if the oil's rising, input costs are rising, we would start to see the extra cost for manufacturers starting to be passed through to consumers by way of increased prices. We're not seeing too much pressure yet. One would argue it's possibly early days though, because everyone was really hoping that by now the Strait of Hormuz would be open and the oil would be flowing back through again. But perhaps actually that's not the end of the good news message. Because apart from inflation, we've got, well, that's all lovely, Richard, but is the UK growing? Is the economy growing? The total amount of goods and services we produce in the UK, how's that looking? Well, pretty good actually. If you're attracted by slightly lower numbers, it's still pretty good in comparison. So what we saw with GDP, that gross domestic product, that total value of goods and services in quarter one of this year actually grew by 0.6%. Doesn't seem a big figure, possibly isn't a big figure. Actually, comparatively though, best of the G7. So thinking about G7 countries like the US, like Japan, we saw GDP in the UK outperform the other members of the G7, not just in quarter one. That carried on to quarter two. So you can see from the graph what quarter one was. In quarter two, actually, we saw that increase slightly down on quarter one. The increase was 0.4%, still the strongest in the G7, though. So, in spite of these pressures, what's causing, how come kind of that happened? Why? Well, now, you couldn't get through this without talking about the weather. Well, part of the view in quarter two was it was the hot weather. It's either the rain or the hot weather, hasn't it? This time it was the hot weather that seemingly helped. And the other thing we haven't spoken about was that big event that started in June, the World Cup. So apparently part of the contribution to the GDP was created by kind of what happens with the World Cup and people buying more things for the World Cup. So far, pretty good news actually overall, given where we could have been. So is it all good news? Well, no, it's probably not all good news. I've probably given you all the good news I can at the moment. Obviously, we have a new Prime Minister in the UK. So Prime Minister, so Mr. Burnham now looking at what does he want to do? And this is where things get trickier. So, one of the big topics that's been going on for a while now is the amount of debt the UK government has and the cost of servicing that debt. And this is where things are getting tricky because Andy Burnham's come in and talked about a number of the great spending initiatives he would like to apply to make people's lives better, to make people's lives easier. But those spending commitments have to be funded. And it's how they're going to be paid for that's starting to worry the market. So this is where things are getting tricky. So the yield on bonds or UK government gilts, those yields, as you can see, have been going up, and they've been going up steadily now, pretty much for 5 years. What does that mean? In really simple terms, the market is expecting interest rates to rise. What that means is going to cost the government more to repay the money it already owes to borrow more money. So servicing that debt and borrowing more money gets even more expensive. That means the government, in theory, has even less wiggle room because more of the money that's available is going to have to go to service the debt, yet alone borrow more. And yet here we are with these spending commitments over, perhaps giveaways. So VAT on energy bills starting to come down a bit. There's been a number of initiatives Andy Burnham's talked about and would like to still work on further. But these have to be paid for. So the markets are saying, be really careful here. We're looking at this. We're expecting interest rates to go up. This is going to, kind of cost you more money to service the debt, government. You want to spend more money. Things like defence are coming into play. How is the government going to balance the books that need to be balanced of the spending commitments and the debt having to be serviced? And that's probably the big question mark that is a worry bead at the moment. So where does it leave us? Well, I guess we're all hoping an end to the war relatively soon as possible. Oil prices start to stabilise. Otherwise, it is very likely we are going to see those inflationary pressures start to come through in H2. Inflationary pressures may well impact GDP. None of that is going to help what the government's trying to do with regards to these spending commitments. So far, some good news, I hope you agree, from H1. Now we'll see in H2 how that starts to follow through. So I'll be back again over the next 3 months to keep you posted on how it is looking. But in the meantime, I hope that's been a useful update. Thanks for watching and bye for now.